Hello everybody, this is Mohammed and today I want to discuss about assessing credit risk by the financial services industry using data analytics and AI. So what is credit risk assessment? Assessing credit risk involves evaluating whether a borrower has the capacity and intention to repay a loan. There are 5 C's associated with credit risk assessment. They are credit history, capacity to repay, capital, the loan's conditions, and associated collateral. Credit risk assessment impacts all of us. As an example, I will single out the housing market. Depending on the credit risk assessment, it can impact whether we will get a loan or not, the rate at which we can borrow the loan, the amount of money we can borrow, and the closing date on a house. In 1968, the Fair Housing Act passed with the idea of eliminating credit risk assessment biases when it comes to lending for housing. What happened was, as soon as the act passed, top banks introduced a program called subprime mortgages, which were designed for borrowers considered a higher risk. Minorities were targeted for risky subprime loans, which had nothing to do with the borrower's ability to repay. So this is an example of human bias that existed before AI. I wanted to give a brief industry overview before continuing. In 2023, IIF and EY jointly published a survey reporting on 65 financial institutions across 9 different regions on using AI/ML with data analytics. They found that most institutions had less than 50 use cases, while 15% had approximately 350 use cases. Some companies use innovative solutions. For example, Capital One targets subprime customer using the creditworthiness assessment tool, which is powered by AI/ML and data analytics, and they identify customer it considers less risky than their credit score suggests. They offer packages which are more attractive than their peers, and in this way able to gain more customers. There are 2 major problems faced by the industry. The first is building and deploying a traditional credit risk model can take many months. Traditional models produce great results in stable economic conditions, but they underperform under sudden shifts in events. We are all aware of the inflation that's happening around us. And I took a snapshot from Yahoo Finance on 30-year fixed rate mortgage. And we see in 2021 that the interest rate was below 3%, and today it's above 7%. The problem is traditional credit risk models are too slow to react to change and can give inaccurate results that can cause financial losses to this type of industry. The second major problem is traditional models lack both in data quality and data quantity. For example, traditional models label motorcycle drivers as high risk without considering other important factors like employment history and credit score. As an example of lack of data quantity, most traditional models take the data from restricted sources, such as regulated data from FRCA, utility and rent, or payment history. So what we see is the lack of the permutation of data that ties to data quality. And data quantity is the amount of data or the range of the data that is used to evaluate the results. The combination of the two, results produced by traditional models are not always accurate. To resolve this issue, I will give an example of Banco. Banco lost customers because the organization was slow to implement changes using traditional models. A couple of things happened. The first is their competitors adjusted prices for their consumers, and the second is there was a change in the market segment. Both of these were overlooked by Banco, and they ended up losing a lot of customers in the process. To address these changes, they implemented data analytics with neural nets, which use nonlinear statistical models to identify patterns and adjust models to deliver the best results. The implementation resulted in drastic performance improvement for Banco, and they transformed their organization into an analytical competitor. To go back to our first problem, which was volatile changes in the economy, we can apply this concept or the solution that was implemented by Banco. We will discuss about the second issue that traditional models faced, which relates to data quality and data quantity. What organizations can do is to assess credit risk scores. They can use additional sources of internal data to add to the assessment. And the second is they can take a wider range of data. One of the problems with traditional models is it's too slow to generate results, but that is not the case with AI-driven models. The results are a lot faster. So on one side, you have a larger variation of data, more permutations of data, and the second is you have a larger range of data. A lot of companies use what they call a data lake, and they are connected to cloud containers and divided into microprocessors. Actually, they don't even use microprocessors. They use GPU for faster speed. These are asynchronous stateless models which can take chunks of data and return results at a much faster pace. Therefore, the data quality and data quantity issue can be addressed using AI/ML and data analytics, which traditional models cannot. What Experian discovered is they can improve their accuracy from 60 to 70% by applying AI models. And this enables lenders to make better decisions by comparison to traditional credit risk models. Although data AI/ML models can be used to improve the performance and accuracy of credit risk assessment, it can also hold biases, especially against marginalized communities. To illustrate this example, I took a snapshot from The Economist, which refers to the Federal Financial Institutions Examination Council, and we can see that Black communities have the highest rejection rate from home purchase loans and home refinance loans. If this kind of data is fed into data AI/ML models, it will hold biased results against certain races. And this can be a problem for any financial institution. To get around this, the European Union has introduced strict laws on how the data is used, and they also include restriction of CCTV footage and also manipulation of image by AI with clear labels and the use of data in certain fields. Credit risk assessment is certainly one of them. With time, more and more financial institutions will adopt data analytics with AI/ML. It'll speed up the lending process and improve the accuracy as their data lake and the quality of the algorithms improve. They will also have to face regulatory check marks to ensure that their customers are protected. There will be less and less AI biases and human biases as algorithms make sure that there are no inconveniences to the customers. Finally, there will be better packages that are calibrated for specific credit scores so that they can retain or attract new customers. As a conclusion, I wanted to mention AI/ML and data analytics can substantially benefit credit risk assessment businesses in a constantly changing landscape. There are ethical concerns regarding AI biases, and there needs to be careful assessment of AI/ML applications so that there are no reputational risks for financial organizations. Furthermore, there should be regulatory check marks to ensure that no privacy rights have been violated, and also there's better transparency for customers on how their data is being used. As a personal reflection, I believe financial institutions have a lot of opportunities to grow when it comes to credit risk assessment with AI and data analytics. Organizations need to hire skilled employees such as data scientists and machine learning engineers so that they can change their processes and better serve their customers. I hope you enjoyed my presentation. Thank you.